In this video, I'm going to start into Chapter 9. Chapter 9 has two different topics, behavioral finance and technical analysis. Here I'm going to start into behavioral finance. One way to view this chapter is these are topics that challenge market efficiency. So both of these, behavioral finance and technical analysis, are ones that run counter to the notion that markets are efficient. Let's start with behavioral finance. I'm going to first tell you what behavioral finance is, and then we'll talk about so-called information processing errors in that context. Let's see what behavioral finance is. So behavioral finance is a financial market model that emphasizes potential implications of psychological factors affecting investor behavior. That's a fancy way of saying that from the behavioral finance perspective, markets are the interaction of people. Turns out people are not perfect decision makers. And in fact, this area came out of psychology. In psychology, they will run tests on people and they give them new information and they see how they make decisions based on that information. Now, people don't do that perfectly. And behavioral finance was the idea that, well, markets are just people making decisions and interacting. So perhaps we should see some of those errors that people make in the way they make decisions showing up in markets. And so they went out looking for that. An important point of this is that it definitely runs counter to the efficient market hypothesis. And in fact, the behavioral finance approach really has to push back against market efficiency because the market efficiency argument would be the following. Well, if people sort of make mistakes in the way they make decisions in markets, some smart hedge fund is going to go take advantage of them, and that's going to squeeze it out of the markets. So we'll see later one of the pushback against that by people in behavioral finance is they're going to say the existence of irrational investors. What do they mean by irrational? Not necessarily irrational, just not perfect decision makers. They'll say that that is not sufficient to render capital markets inefficient. So again, we're going to see that later. That's sort of the pushback, the back and forth between behavioral finance and efficient markets. All right. Let's jump into some of the main claims and ideas in behavioral finance. And in this first part, what I'm going to do is I'm going to talk about so-called information processing errors. Again, this came out of psychology, and they basically do tests on people where they give them new information, and they see that people tend to have certain biases in the way they make new decisions, and that should potentially show up in financial markets. So let's talk about some of those. All right, the ones that we're going to talk about here are the memory bias, overconfidence, conservatism, and sample size, neglect, and representativeness. Now, as we go through here, as we go through these different information processing errors and other behavioral biases, it's a good idea to ask yourself whether you're subject to these. The claim is that many people are subject to these. That's what happens when they do these tests. And so it's kind of fun to ask yourself, how many of these am I subject to? And does this affect my trading? So let's start into these. We're just going to have a slide on each of these and I'll explain what they are. All right, so the first one here that we're going to talk about is the so-called memory bias, sometimes called the recency bias. I'll call it the memory bias here. And that's the following. People overvalue recent experience compared to prior belief when they're forecasting. What is that? It's what just happened to you. People tend to overemphasize that or overvalue that a little bit. Or you can think that people have short memories, right? It's just that last thing that they remember. All right, one part of behavioral finance is taking some of these ideas that are not necessarily connected to financial markets and trying to find a connection. Now, some of the connections are pretty strong, as we'll see in later ideas. Some of them are weaker, and you can judge that on your own. This one, to try to connect it to financial markets, might be something like the following. If a company had a single good quarter with high earnings, people assume that it will continue without taking into account performance in previous quarters. How does that correspond to the memory bias? It's that last thing. They have the short memory. That last thing tends to affect them too much. Let's move on to the next one here. The next one is called overconfidence. And what is this? It's just like its name implies. People overestimate precision or beliefs or forecasts, and they overestimate their own abilities. This is kind of a fun one. Why? I'll show you some examples here. This one is outside of financial markets, but still kind of fun, gives you the flavor of overconfidence. They do surveys of people, And 90% of drivers in Sweden rank themselves as better than average. Kind of funny, right? Because only half of the people can be better than average. Can't have 90% of the people being better than average. So you get results like that, and it implies that people overestimate their abilities. Okay, could this potentially apply in financial markets? Here was an interesting study. It's a study from 2001, and I believe they looked at Schwab accounts, and they found that the more that people trade, the worse they do. And they said, what explains this? Why are the people that are trading a lot doing the worst? And they said, maybe this is the overconfidence bias. That is, many people are overconfident, and so that causes them to trade a lot. And in fact, they shouldn't be trading a lot. They actually do worse than if they didn't trade much. Very interesting, too, in the study, if you dig in, they broke it down between men and women and single and married. And it might not come to you as a surprise, but the ones who traded the most and did the worst were actually single men. And then it was actually married men who came next. And then it was actually women who traded the least and did the best. So kind of interesting, some neat results there. Let's move on to the next one. This is called the conservatism bias. And this one says that investors are too slow in updating their beliefs in response to recent evidence. Now, honestly, when I ran into this one, I thought, you know what, this has a lot of the flavor of being actually opposite of the memory bias and the recency bias. So I'm not sure exactly how you square those two, although this says that some of the time if somebody has a locked-in prior belief, it's hard for them to update that. Let's see how that could potentially show up in financial markets. This one might be something like the following. Underreaction to good news about a firm might result in an upward trend as the information becomes fully reflected in the price slowly over time. We remember the momentum anomaly. That's that winners tend to keep on winning and losers tend to keep on losing. And so one potential explanation for that is the conservatism bias, that those winners, that information is just being baked into the price slowly, and that's causing actually an uptrend. That's why the winners tend to keep on winning. Or, bad news slowly, and that's causing a downtrend. So that would be one way to try to connect the conservatism bias to something we see in trading. Let's do the last one here in this section, the last of the information processing errors. This one is called sample size neglect, or another name is the representativeness bias. Okay, what does that mean? It says people are prone to believe that a small sample is representative of the overall population, and they infer patterns too quickly. So these things, sample size neglect, is that this small sample, that is, somebody might sample just a couple of their friends, and then they generalize way too quickly, and that's where the representativeness comes from. They take a small sample, and they're neglecting the fact that it's too small, and they assume that it is representative of everybody, and they generalize very quickly from that, okay? So basically, you can think of this one as people generalize very quickly. Here's an example of that in the context of markets. A couple of friends tell you that they are buying Tesla, and then you immediately generalize that everybody must be buying Tesla. And it's sample size neglect because your sample is too small to generalize from. Yet people tend to take that small sample and just very quickly generalize, right? And they tend to do that in a systematic way. All right, so this one has the name sample size neglect and representativeness.